Hey there, everybody. Dustin TenBroeck here. We got another episode of the Presidio Perspective. So my name again, Dustin TenBroeck. I'm the president of Presidio Capital Management. We're a registered investment advisor and independent wealth management firm. Hopefully many of you know that already. So this is the 7th episode of our webinar series, the Presidio Perspective. So it's just me today. Don't have any other panelists or guest speakers. Thought it'd be good to just get your full deserving attention for 1 week. Been longing it. So, glad that you guys can join us for another evening here, and looking forward to seeing you guys at some point in the future. But it's been wonderful being able to get in front of you on a weekly basis now for 7 weeks in a row. And, when we first started this, there's just so much happening. We said, well, we'll keep this weekly webinar going for a while, and then maybe we'll switch to, bi-weekly or semi-monthly. But the way that the information keeps rolling out, I don't know, we might have to go every other day. There's just so much information. So, a lot of what I have to share with you today was information we just got hours ago, but lots of information going on. So glad that you guys can be here. I'll stop stalling for the attendees to join. I still see a number of people signing on here, but we'll get started with tonight's presentation. So I'll share my screen with you. So first and foremost, I did want to mention that I'm really excited to announce that we have a new team member at Presidio. So at Presidio Capital Management, we have Luke Jacobson joining us as a wealth advisor for the firm. And Luke brings with him just a wonderful character, knowledge, sense of the markets, business, and a lot of experience that in just a short time he's been with us, we are already greatly benefiting from. So in his prior experience, Luke handled institutional money management, has covered construction and analysis of equity portfolios, investment communication for institutions, foundations, and high net worth clients. So he was the principal and portfolio manager for a local firm called Wall Streets and Associates that used to be headquartered in La Jolla. So focused on wealthy endowments, institutions for portfolio management. So he has a master's in finance from the University of Missouri and is a chartered financial analyst. We are just very excited to have him on the team, and we've already benefited greatly from his knowledge and experience, and thus so will you. So I'm looking forward to having Luke join me in future episodes of the webinar, but please join me in welcoming Luke to the team. So happy to be one of those companies that actually gets to be creating jobs instead of losing them during this difficult time. So just as a reminder, all investments contain risk. There's no such thing as a risk-free investment. So any investment strategy has the chance to lose money. And we are not giving anybody any specific tax, legal, or accounting advice in these webinars. They're informational, but please make sure to consult your tax, legal, and investment professionals before making any transactions or decisions. So we'll start out today talking about some of the economic news and updates, go into what's happening in the markets and kind of the outlook for the markets. We had a recent report that we got as advisors from Vanguard that we'll share with you, and as well as talking about the disease and some updates there. So on Monday, there was a live interview with Jeffrey Gundlach. And so if you know who Jeff Gundlach is, he is he's called it the Bond King. So dethroned Bill Gross some years ago with that title. So Jeff Gundlach works for his company is Double Line Capital, and he's called the Bond King. So he came out in a live interview with CNBC with some comments about how dire the situation might be. Now, I do want to comment that the Presidio perspective, we take on lots of different perspectives, and that's our job to try to help make informed decisions for portfolios and financial plans. And we have to always take it with a grain of salt and understand the source of our information. So when we listen to the equity strategists, some of which we've had on our calls before, we're going to know that they're going to slightly lean towards that bullish nature. And the bond strategists and fixed income strategists typically always lean towards the bearish sentiment of the stock market. I remember Bill Gross, who used to be called the Bond King, is a famed quote about him was, he is famous for calling 10 of the last 2 recessions, right? So anyway, we want to listen to what they have to say. That doesn't not make their perspective wrong, and nobody understands what the market is going to do in the future. So it doesn't mean that, you know, they tilt one way or the other, that the information is not good. We just keep that in mind. But, you know, Gunlock is one of the smartest people on the planet, one of the best investors on the planet. So we're very intrigued to hear what he has to say. So in this interview on Monday, he says, I think we can take out the March lows, and that people just don't understand the magnitude of the social unease that's going to happen. And this is something that I talked about in last week's episode, is how is the psychological and social impact going to be on the US consumer? He goes on to say, we've lost every job that we've created since the bottom in 2009. Every single job is done. And that's just incredible. In a certain sense, we really have not left the global financial crisis. If you think about it, our unemployment rate is now worse. And I'll touch on unemployment later in this episode. And so what Jeffrey's saying is not true. I mean, or is true. It's not untrue, rather. And these are some pretty factual statements that he's giving us. I think the debate is on Wall Street, how long are those numbers going to persist? And that the equity strategists might say, well, we had a very robust economy going into this. It wasn't a slow breakdown, something that we mentioned in our first episode of this series. And so that is a lot of what the debate is about, of how robust is the recovery going to be, how quickly can it come, and the stock market is trying to price that in. Later in the interview, he says there was no economic growth in 2019. Okay, it was all debt. He says the national debt grew more than nominal GDP. Meaning one other thing is that a lot of people don't understand is that the 2019 economic growth was basically all consumption. And we talked about that in prior episodes too, of how much the US consumer means to our gross domestic product, of which we'll show you a slide here in a minute. But he goes on to say that 90% of the economic growth that we experienced last year was due to US consumption. And that the consumer is typically about 70% of gross domestic product. But the growth of GDP last year in 2019, 90% of that was fueled by the US consumer, which we know on average lives paycheck to paycheck. And so we had high employment, right? Rising wages. So people are making more money and spending it immediately. Some of them spending it before they get the paycheck on credit cards, et cetera, and using that credit card to pay that paycheck to hopefully pay down some of that credit card. So we had a robust US consumer because they were employed and making money. So what happens now if they are not employed and not making money? And what does that mean for the GDP? Well, I mean, we can imagine it's probably not going to be good. If we look at this chart from the Fed, you know, you can see here that this is the percent of GDP that the U.S. consumer has made going back to the 1940s, and that after World War II, you saw a drop, although not significantly. I mean, the U.S. consumer has really driven our economy, right, and to being the best in the world. And so when you see that, you know, down here, maybe it got as low as 59% of the economy in some of the low years and has risen steadily. But since 2000, you can see the US consumer has been 67 to 69% roughly of our GDP, right? And if you look at kind of this timeline, I think of what's going on in the country, you know, the massive rebuild and infrastructure that goes on after World War II, you know, the massive infrastructure need with a baby boom generation of schools, hospitals, bridges, roads, cities, suburbs, et cetera. So lots of other things that go into the economy and gross domestic product during this era, coming with a tech revolution starting in the 80s and those baby boomers coming of age in the workforce and making money and spending it. And that's where we see the massive increase. This was the handoff to Generation X coming in to the workforce, which caused a lot of problems since they were smaller than the baby boom generation and kind of led to some of that issues we had in the financial crisis. But you can see the U.S. consumer, even during the last recession, even made up more of the gross domestic product. So over the last 20 years, what we've experienced is very cheap money. Right? The Fed has been very dovish with interest rates. So we've extended credit and finances, and the Fed Jerome Powell came on today, which we'll talk about in a moment, continuing to throw lots of money at the economy. So that is the hope of what's going to solve this problem. And hey, literally the government is sending checks to households, not something that I thought I would see in my lifetime, that the U.S. Is going to be a government check society. But here we are, and I'm not discrediting any of the measures that were taken by the by our administration or the Fed. You have to kind of try to solve this as best you can, and they're doing, I think, a good job at it. We'll see what problems come down the road with all of this. But how is this U.S. consumer? How badly are they going to be damaged coming out of this is still a big question. We did today get reports on what the GDP reading was for the first quarter of the year, and it was pretty bleak, as we all expected. So in Q1, we had contraction, so that marked the end of the longest bull market in history. So we have just come out of the longest economic expansion in the history of our country, and it ended as of this quarter, as of today. We marked the end of that as we had our first quarter of negative GDP growth. So this bull market ends, and it listed as an annualized rate of 4.8%. Now, if we look at this and measure it against all the other negative quarters we've had since 1947, it's the seventh worst quarter that we've had since 1947 in our economy. And mind you, this is the first quarter. This is after having one of the best quarters, I believe, we've had. We were looking for economic growth to continue for 2020. And so we had a very strong January and February, and we had a weak March. But you can just think of what the second quarter is going to look like if this is where the first quarter lands on the Richter scale. So, the seventh worst quarter we've had in almost 70 years, and on over 70 years. And again, so we're anticipating that when we read the news about how the second quarter looks, one might imagine it's going to probably, break the record. So again, on that light, Jerome Powell came out today saying that the Fed is committed to doing whatever they need to do to help support the economy, and whatever is in their powers, they're certainly doing that. They're pulling out every tool that they have in the toolbox. Some people ask, are they going to run out of ammunition? The Fed is far from running out of ammunition. So there's a lot that they can continue to do to support the economy. So keeping interest rates low for the foreseeable future is something they've told us. They've been very good at kind of telling the market what to predict and what they're going to do without any surprises. And that's always good on Wall Street. Wall Street doesn't like any surprises. So the Jerome Powell and the Fed has continued to take a dovish stance on monetary policy, which we know from the Great Depression is very important during these recessionary economic contractions. So hopefully this will stave off the depression that a lot of people wonder if we are going to slip into. Unemployment. Sorry, do you guys need to take a break? Maybe look at a smiling photo of a child or something like that, something to bring some good news. I know this isn't the most uplifting stuff. I look forward to sharing some uplifting data with you, but when we're looking at economic data, it's not good. So I probably should have prepared you for that. Maybe I'm just getting depressed reciting it to you, but so I'll go on. So unemployment, we know is bad. So it's now exceeding 20%. So 26.5 million jobs have been lost since the start of this disease. It's the highest level of unemployment we've had since 1934. Unfortunately, also, of those who've claimed unemployment, 71% of the Americans who filed did not receive their unemployment benefits in March. So you have this, U.S. consumer that's driving the economy because they're spending their paycheck that they're getting immediately, right? As we know, the U.S. consumer lives paycheck to paycheck on average. 70% of them do anyway, and 70% of the economic growth is fueled by that. So That doesn't bode well when they're unemployed. And then also when they don't have their paycheck. Now, the stimulus checks did get out, and some people made more in their stimulus checks than they did from their job. So, there's some help there, but we're waiting for unemployment benefits to get to many Americans. So again, just as this goes on, how damaged is this U.S. consumer going to be? So remember that they drive a vast majority of the U.S. consumption. So, 26.5 million jobs, these in like an instant is just beyond anything that we have ever experienced before in our nation's history. I mean, nothing really close to that, not even in the Great Depression. I mean, at the very worst of the Great Depression, after years of economic decline, it was reported that there was roughly 25% unemployment. But that happened gradually over time. And just to kind of put that in perspective, I'll kind of share with you another slide like we did with oil prices last week of what that looks like going back throughout history. So it'll go fast. But you can kind of see, again, this is U.S. weekly initial jobless claims by the thousands, which are seasonally adjusted. So we're starting off in our chart here in the 200 to 300 range from the 1950s and on and through current day. And this is what we saw in the first quarter of this year. Is it done yet? Yes, it is. Okay. So obviously, this is unprecedented, uncharted territory. Okay, and there's a lot of differing theories of, are those jobs going to only be temporarily gone, right? We have a lot of furloughs, lots of unemployment claims and small businesses. And so, we know that this happened really quickly, really fast. We had a shutdown of the economy. We've never seen this before. And the idea is, how quickly can those jobs be restored? And I think that is the biggest question that Wall Street is really going to have to face in regards to the stock market and what's being priced in. I think right now it's a very optimistic view of how quickly those jobs could be replaced. And so, as we do every month, Vanguard works with its advisors, so their advisor group, and gives them their monthly perspective on the markets. And so we just wanted to share with you some of their views. And so we like to bring in lots of differing views, like we've said, and just share with you kind of what Vanguard has to say and their May outlook on the economy. So they like to give us long-term views, 10-year views of what different markets are going to do, not trying to time the market, but kind of just what they see in a long-term view. So one thing that they note, again, that the United States economy could contract at a significantly greater degree in the second quarter than it did at the worst point of the global financial crisis. Now, I think that everybody is aware of that. I certainly think that Wall Street is aware of that. So that could bode well for the markets, because again, the markets don't like surprises, and it is odd for many people to see all of this economic bad data and the stock market still going through its renaissance and its rally and having a very good day today. But again, this is something that we kind of talked about in prior episodes, and something that you expect to see in bear market recessions. Some of the best days or weeks on record, months on record, some of the worst days, weeks, months on record. And so we still think we're in the beginning to middle of this thing. So again, we're only a month or two in, so there's going to be lots of volatility. We like when the volatility is up. Volatility on the upside, everyone kind of feels good about. It's only when it goes down that we don't like it, right? So growth in the United States and Europe is expected to contract in the second quarter at the steepest pace since the 1930s. So again, something that a lot of people, I think, expect and are pricing in. So they expect a U-shaped recovery. Okay, so we've talked about the different types of recoveries there are. Is there a W where it kind of declines, gets back, and goes back down, similar to kind of what you saw in some of the older recessions we've had on record? Is it an L where it kind of drops down and stays low for a long time, like the Great Depression? Or is it this U-shaped recovery where it has a quick down and then a long time to finally have economic expansion? So they're saying it's going to be a little while before the economy is going to be put back together, and they're expecting at least until the end of 2021 before economic activity will return to pre-COVID-19 levels. So the end of 2021, so roughly 18 months, I think that's kind of in line with some of the stuff we've talked about before. A caveat to this is, of course, if mass unemployment coming out of the downturn continues, that the growth impacts are likely to persist for longer. So again, this is kind of what we've been saying, is that this is the debate. You know, we know we have mass unemployment. We know it's like nothing we've ever seen. The Wall Street knows that. All the strategists know that. We know that. The debate is, do they come back to work when this is over? And if they do, and we were able to keep the U.S. consumer not too badly damaged through different loan forgiveness programs, sending them government checks, the PPP loan program through the SBA, all these kinds of things to try to prop up the U.S. consumer, and what we're hoping is a short-term kind of furlough, that maybe they're going to emerge okay and that the economy can quickly get back on its feet. However, something that I've debated for years is, in the next recession, I've always wondered, how quickly will jobs be restored? And years ago, I was having a discussion with one of our clients that, you know, owns several locations, and talking about the switch of the employee to technology. And the staff that was once used to maintain these store locations has been greatly shrunken down due to automatic inventory processing systems, automatic checkout, you know, all the things that we kind of know that exist. So I think that technology exists and we're using it right now, right? A lot of new technology has been around in existence for a long time that hasn't been embraced. And, you know, this is kind of what happens a lot of times in recessions, is that we find new ways of doing things when we come out. So that is a concern I've always had about a lot of the workforce, is how many of them will come back to a job, or are companies and governments going to now rely on more efficient, less costly technology versus the costly, maybe less efficient staff that once did that job? So again, big debate. We will see how that goes in. But of course, watching the reemployment rate, you know, when we get there, is going to be a big thing that we are watching to see how the markets are going to react. Again, I think that they were pricing in a pretty quick recovery and reinstitute the employment rates that we had prior to this COVID disease. So Vanguard, in their perspective, kind of sees that the current shelter in place measures and the most extreme social distancing rules will be lifted or eased by June 30th. Okay, so that's kind of what they're thinking. And so it's a little depressing. 2 more months of this, I don't know. I try not to think about it. I try not to think about it for my own personal safety and health, well-being. But yeah, we're prepared for the long run. One thing that we like about Vanguard's market perspective is that they always give us their long-term view of, you know, equity and fixed income markets. So at the end of last quarter, they look at, what do we think the stock market and the bond market are going to do over the next 10 years? And so this is just their perspective, of course, but they see that U.S. equities, they see in the next 10 years, looking at a 5 to 8% roughly rate of return, or 4.8 to 7.8% rate of return in the U.S. stock market. Like many other institutional money managers, they see that global equities, ex-U.S., are likely to experience far superior growth, with 8.3 on the low end, which is above the U.S. domestic high end, to up to 11.3. Okay, and a lot of that has to do with valuation and a lot of other factors, and something that we will cover in future episodes. On the fixed income side, not expecting a lot of growth. Of course, interest rates are near zero, so you're not going to get paid a lot for owning a bond that is issued today. So if we think about it over the next 10 years, you know, we got a new bond, how much is it paying us? So interest rates are really low. We're not making a lot of money. And of course, as interest rates go up, the price of a bond will fall. So they're not expecting very good returns out of fixed income markets over the next 10 years. So again, a globally diversified portfolio is something that we look at very seriously and institute at Presidio, and Vanguard is kind of echoing that sentiment of how important that might be for the next decade. Did I not show you this yet? Was I just talking without sharing that with you? Okay, sorry. Here's the U.S. fixed income guests from Vanguard over the next 10 years. So more on the markets. So Ray Dalio, who is one of the most famed and runs the world's largest hedge fund, Bridgewater Associates, came out in a live internet interview this week and talked about the greatest mistake of all investors. And I thought that it was really good in light of the current market and current times and what you're seeing in some of the names of the stock market that everyone knows and loves, especially knows. And that he goes on to say, the greatest mistake of all investors is to think that what has done well lately is a better investment rather than it's more expensive. And what has done worse lately is the worst investment, meaning get me out of it rather than it's cheap. Now, this is something that we do for our clients and make sure that those mistakes are avoided, but absolutely something that many of us on the call can probably share a time or two. When you look at the lineup of the 401k options that you had and you said, wow, this fund did really well last year and the fund that I'm in didn't, I'm going to go ahead and make a switch. So it's very important to look at not just what's doing well, but what does that mean for the price of that fund, sector, stock that you are buying into, and so a lot of people are saying, wow, look how well maybe some of these technologies are doing. And now you have in this S&P 500, okay, the 500 largest companies on Wall Street, of all those 500, 20% of that index is in 5 individual stocks, right? So when we buy the stock market today, meaning the S&P 500 index, you're going to have most of your money just allocated to the 5 of those companies that's making up that index that has fared very well. So it's important to know as investing as what's going on, not to get too distracted by the shiny objects. All right. So now a little update on the disease. There's been some updates there, good and bad. So some good news today. So the numbers still are staggering and depressing. So worldwide, we've reached over 3 million. Okay, so 3 million cases across the globe, which is an increase from 1 million just 3.5 weeks ago. So it's tripled in the last 3.5 weeks globally. And that's if we believe the information that we're getting out of China. Boris Johnson, and talking about some of the reopening of the economy, the United Kingdom Prime Minister Boris Johnson says easing lockdown restrictions would throw away effort and sacrifice of British people. The Prime Minister tells citizens to contain your patience, right? So we're trying to do the same here. Germany, interestingly, their labor minister wants to enshrine into the law the right to work from home, if feasible, even after the pandemic subsides. So there's you can already see there's going to be a lot of interesting debates that are going to go on in states and local governments and national governments when the economy does reopen, and what is that going to look like as it goes through obviously various stages of safety. In the United States, we've now have passed over 1 million cases, so about a third of the world's cases. So we have exceeded the 1 million mark of confirmed cases. Deaths are nearing 60,000, okay? In just a relatively short period of time, this has happened. And those numbers are going to continue to climb. And again, it's seemingly focused on those over the age of 65. However, still, when we look at cases in New York, it was like 25 to 30% of the deaths are still younger than 65. I think a median age is in the 50s. So, this disease is affecting a lot of people, obviously. It's interesting that in a recent poll, that was done by a popular work app. I'm forgetting the name, but 80% of the workers polled said they would not feel safe returning to work if the state were to lax restrictions and reopen the economy. California was 5th lowest in the confidence rate on the list, where only about 16% of those polled in California said that they would feel safe returning to work if the economy was reopened. So, I think that, again, we have a lot of work to do based on the psychological nature of what's going on for us to reopen the economy and go back to any sense of where we were before this all happened. On the local cases in San Diego and Orange County, this is San Diego. So we saw a surge recently in cases. Who knows if that's related to the protesters out there, mostly related to increased testing. But you kind of see this curve going through since March, right? Where we started to kind of flatten out and you saw it got really steep. So cases were averaging 40 to 50 kind of range. And then we've kind of got back into the triple digits here for the last week or so and seen an uptick in cases. So San Diego now 3,300 total cases reported. Orange County, kind of similar thing where we saw the cases ramping up, started to slow down, and then also we're seeing some triple digit cases and growth going on over the last week. So something that we're definitely looking at locally as far as, what kind of lives can we expect to experience? When can we go back to work, and how are these cases going to potentially change as we look to reopen the economy? And gosh, all the news about the beaches reopening, I mean, as limited as they are, I don't know if any of you brave souls out there ventured out there. We haven't yet, but I mean, it's really nice to think about being able to go out of the house, back to the beach, back to our friends and extended family members and social gatherings. But it just seems to me that we have a long way to go before we're going to have the confidence rate to do that. And in many other places, we've seen this uptick in the disease count. So something we're all monitoring and watching very closely. We did have some very good news today regarding the testing viral drug remdesivir, which showed some quite good news according to Anthony Fauci, and set a new standard in the care for COVID-19 patients. So working on this drug, we kind of a couple of weeks ago or last week, maybe had some more disappointing news. But what they found in the most recent trial is a suggested survival benefit for those taking the medication, and that the mortality rate of the group was dropped from about 11.6% to 8%. So not a miracle drug, but absolutely a sign that we have found something that actually tests that it is an effective treatment in some way or the other on combating this disease. So basically, you're fighting an opponent, and just imagine like everything you're throwing at them, you're in a fist fight, you're punching and nothing happens. They're not phased, they're not hurt, they're not backing up. And then finally, you might be losing the battle, but you got one blowout and they buckled. And so that this opponent can be weakened. That's something that you can do. You're going to have a chance in fighting this disease, and you got to keep working on that. So Anthony Fauci relates it to 34 years ago when they first initially discovered the drug ATZ, is it, that was able to show the first early signs of combating the HIV virus. And obviously they had a lot of work to do with that drug, but it's very good news for the disease. And the reason why you saw a really big rally in the stock market today. So the stock market had rallied before Jerome Powell had come on, and really kind of on the heels of this good news in their testing. Also, I think what's probably more important is the recovery time dropped approximately to 11 days versus 15 days with the drug. Now, when I initially saw this and I looked at both of these statistics, I said, well, that's not too compelling. And Luke, our new member, said, well, you have to look at it a little differently, Dustin. One way to look at this is that it has increased the capacity rate of our healthcare system by 29%. And that is really the big reason, he went on to tell me, of why we have these shut-in orders and why we have these real restrictions on our economy and sheltering in place, is because of fear of the overrun of the healthcare system. So the more that we can do to lessen the amount of deaths or hospitalizations or days of recovery will greatly expand the capacity of our healthcare system, which will be very good news for the confidence rate and reopening the economy. So we've got our first bit of good news today on that front and battling the disease, so we can all kind of, be joyful and take that victory today. I wanted to kind of finish tonight with a little analogy of what we see going on, and how the markets kind of look at this disease and the different phases that we're experiencing. And so many we've already experienced, and what we can continue to experience. And that's where really the debate is, as how are markets and the economy going to perform, in the months and years ahead. So when I look at this, I really kind of think of it as like weathering the storm in a quite literal sense of how you would have to weather a bad storm. And the first thing that happens when we're looking at the storm is we see the rain clouds and we see the storm clouds forming, and it's not looking good. So you kind of go back to the time when we saw these cases ticking up in China, Iran, and Europe, and we said, this is something really serious, that it's going to rain and it's going to be a pretty big storm. So we kind of knew that happening about a month and a half ago. You move on to that, and all of a sudden the rain starts pouring. And this is kind of when the disease started popping up in Washington and New York and some of the eastern and western states. And we saw that, the rain started to fall, and it was getting heavier and heavier and heavier. And we knew that it was going to be a pretty long battle and a long storm as we went through. As the storm keeps coming to fall, you start to see the streets flooding. And this is kind of where we've been, is seeing this rising tide, seeing the water continue to rise with the rain continuing to fall down on us. And we're getting warning signs that it's possible that the levees are going to break. And I think that's when you saw the real panic in the market in March, is that if we do have a overrun of the healthcare system, that there's not going to be any containment for this disease, and it would be rampant and greatly spread, and just wreak havoc on our economy. And so we took temporary measures, we'll see how temporary, but to shelter in place and to try to prevent the levees from breaking. And then, where we get to is today. We might look back and argue where we saw a bit of blue sky. We saw, maybe this started to happen, a couple of weeks ago when you saw a flattening of the curve. And when we saw the flattening of the curve, we had confidence that the levees weren't going to break, the healthcare system wasn't going to get overrun. Now, yes, we're going to be damaged from this storm, but that, it's not going to be the dire consequences that we thought it was when it first started raining. And so now, do we see a little bit of blue sky where we can see now visibly an end to this storm and this disaster, where we can get back out of our houses, have a reopening of the economy, and potentially find some treatments for this disease. And when we do emerge back into the economy, it's not going to look like it did, prior to the storm. And so we're going to go and try to go about our life, and it's going to be very different, right? We're required to wear masks here in a couple of days, and it's just going to look and feel a lot different than it did prior to COVID-19. And we know that. We know that there's still going to be plenty of people who are sick, plenty of people who are dying. It's going to be tough to look past those statistics and facts as we go. Certainly everybody has a big desire and demand to kind of get back out there, I know, socially and for their mental health and well-being. But it's going to be different. And we don't really know what's going to come next. Because what happens after the rain kind of goes away and we have massive testing and antibodies and antiviral drugs, and we feel like the disease has been eradicated or combated, now it's time to assess the wreckage. And this is something that you can't do while the streets are still flooded. You don't know how deteriorated everything is, what's going to be left standing. And I think of the massive unemployment that we have, and how bad is it going to be when we look at the U.S. consumer after this is all done and start to assess the wreckage. So there's no way that we can start predicting this. People have differing opinions, but nobody has the playbook of what this is going to look like after we come out of this. And I think that the stock market at least sees that the end is coming, the sky, the clouds are parting, and that we are going to get back out before there's too much wreckage. There's obviously a lot of scenarios that we've covered before, where if it starts raining again and we have to shelter in place because of a second wave, the damage is going to be pretty severe. Okay, so there's different things, there are different possibilities. We don't know which one we're going to have, but we have to prepare to live with all of them. So at some point you assess the wreckage. After you assess the wreckage, it's time to rebuild. And this is the work that it's going to take to put back together the economy. So this is going to be massive action, continued further action by Congress, by our governments, by governments globally, monetary and fiscal policies, and also our corporate America. And is the US consumer going to come back with the confidence? A lot of it is up to the US consumer and how quickly this economy is going to be put back together and start to rebuild. One thing that Wall Street does know, and that we should all remember about these economic cycles, is that we understand that there is a cycle where we have economic expansion, we have contractions, we have recessions, and then we have growth and expansion again. And that these recessions are necessary when it comes to how economies work and how economics works. Because in a very good economy with high employment, with high wages, you can keep a lot of bad businesses and a lot of bad ways of doing things in existence. And it spurs the potential for future economic growth. And that when these recessions happen, they're not fun. And we have to be able to weather the storm. And this is, of course, what we talk about at Presidio and why we have long-term time horizons on the stock market and systematic rules for rebalancing different pieces of your portfolio where your income's not affected because a recession happens. This is something that we anticipate. Inflation, taxes, market crashes. They're part of investing. And what happens on the other side of this is that when we get through the recession, there typically tends to be that renaissance again, where you have some great expansion and growth in the economy. And there is a lot of positive things, specifically in healthcare and technology, that will greatly benefit all sectors of our economy coming out of this recession. So Wall Street also knows this. And so if they think that it's going to be a likely quick recovery, they look forward to that economic expansion. Because although we want to go back into the house that we used to have, it's no longer there after the storm and we have to rebuild. But when we rebuild economies, we rebuild them better than they were before. And so it's really important to remember that. Okay, so it's not, we're going to share lots of bad news as we go through the second quarter, but we know what's on the other side of this. And as investors, you can make a decision of how you want to balance those risks, and asset allocation is going to be really important. You know, do we have the different pieces of our portfolio that are going to benefit from economic expansion? Absolutely, we will. Now, are we going to have enough pieces set aside to kind of weather the storm, and maybe some opportunistic pieces that deal with the unknowns? And there's a lot of unknowns in the market. So that's kind of how we view the different pieces of our portfolio and what we're going to have. So we remember we're long-term focused. Okay, so we listen to Warren and maintain our patience. Okay, and try to be fearful when others are greedy, and greedy when others are fearful. And again, you just kind of take a look at that market sentiment today and where we are. So, but I see that if you have missed earlier talks, you can find those going to presidiocm.com. So if you go to our website, presidiocm.com, you can listen to our prior episodes. You can request an appointment right from our site, or you can, of course, give us a call at 858-461-4959. All right, everybody. I wish you a wonderful week ahead and lots of safety. Dads, sons, don't forget, do your Mother's Day shopping. It's coming up quicker than you think, so get on top of it. It's really hard to do that Mother's Day shopping right now. I can't order through the Amazon account. My wife's going to see it, so I got to figure that out somehow. But anyway, thank you guys. Have a wonderful week. We'll be with you guys next week, Wednesdays at 4 o'clock for the Presidio Perspective. Thank you.